Imagine two people earn the same salary, same city, same hours, same economy. One slowly builds wealth that compounds for decades. The other runs in place, calls it life getting expensive. Now here's the uncomfortable part. This isn't an accident, it's architecture. Modern financial systems don't just reward wealth. They are quietly built to protect and multiply existing wealth first, and everyone else second. 8. And once you see the design, you can't unsee it. Right now, this matters more than ever. Asset prices are high, debt is everywhere. Governments print money like it's a software update. Markets wobble, recover, and hit new highs. Every time there's uncertainty, something strange happens. People with assets get richer. People with only income get squeezed. That pattern isn't luck, it's structure. Let's start with the foundation. Money itself. Most people think money is a neutral tool. You work, you get paid, you save, you spend. Fair enough. But modern money is largely created through debt. Banks issue loans. Governments run deficits. Central banks expand balance sheets. New money enters the system not through wages, but through credit and financial markets. Who gets access to that new money first? Not the average worker. It flows first to banks, corporations, investors, and asset buyers. By the time it trickles down into wages, prices have already moved. This is sometimes called the Cantillon effect, but you don't need the term. The result is simple. Those closest to money creation buy assets before prices rise. Everyone else pays higher prices later. That's layer 1. The system expands in a way that favors asset holders. Layer 2 is even cleaner. Tax design, If you earn $100,000 from a job, you're taxed as income. In many countries, that can mean 25 to 40% gone before you even touch it. But if you earn $100,000 because your stocks went up, that's capital gains, often taxed at a lower rate, sometimes much lower. And here's the twist. You don't even pay that until you sell. Wealthy investors can let assets rise for years without triggering taxes. Workers pay continuously. Every paycheck. No delay button. Then comes the move that almost feels like a cheat code, borrowing against assets. If you're rich, you don't need to sell stock to live. You can take a loan using your portfolio as collateral. Loans aren't income, so they're not taxed. You get cash without creating a tax bill. Meanwhile, your assets can keep appreciating in the background. Income gets taxed, appreciation gets deferred, loans get a free pass. That's not a glitch, it's design. Now let's zoom into crises, because this is where the system shows its true priorities. In downturns, markets fall. Risky assets drop. Panic headlines everywhere. But when losses start threatening the financial system, central banks step in. They cut rates. They buy bonds. Sometimes they buy corporate debt. Liquidity floods the system. What does that support most directly? Financial asset prices. In 2008, in 2020, and in smaller shocks in between, the response pattern is similar. Stabilize markets first. The logic is that markets are the plumbing of the economy. If they freeze, everything breaks. That's not wrong. But the side effect is powerful. Asset owners get a backstop. Not a guarantee of no losses, but a system biased toward preventing total collapse of financial markets. Workers don't get a central bank that props up their salary the moment things dip. Businesses and investors get policy tools pointed straight at their balance sheets. Then there's inflation, the quiet redistributor. When money supply expands faster than real production, prices rise. Wages tend to adjust slowly. Asset prices often adjust faster. Real estate, stocks, commodities, they move early. If you own them, your wealth inflates with the system. If you rely mainly on wages and cash savings, your purchasing power erodes before you can react. Inflation is often described as a macroeconomic challenge. For the wealthy, it can also be a balance sheet advantage. And we haven't even touched legal structure, corporations have limited liability. Investors can take risks where losses are capped, but upside is open-ended. Bankruptcy laws allow restructuring, second chances, negotiated outcomes. For individuals, financial mistakes are far less forgiving. One medical bill, one job loss, one bad loan, and the system feels brutally efficient. Big players get buffers. Small players get consequences. Even information flows differently. Institutional investors get access to private deals, early funding rounds, structured products, tax engineering, and legal advice designed specifically to preserve wealth across generations. The average person gets a brokerage app and a motivational quote about long-term investing. It's not that markets are fake. Growth is real. Innovation is real. Opportunity exists, but the playing field isn't flat. It's tilted subtly, structurally, persistently toward those who already own assets and understand the rules. Here's the irony. The system doesn't call itself wealth protection. It calls itself stability, efficiency, growth, liquidity, risk management, and those goals are legitimate. The problem is that the mechanisms that create stability for capital often create fragility for everyone else. Higher asset prices can mean higher rents. Easier credit can mean deeper personal debt. Market rescues can mean moral hazard. So when you hear the market recovered, ask, recovered for who? This isn't a conspiracy with secret meetings in dark rooms. It's incentives layered over decades. Policymakers fear collapse more than inequality. Financial systems prioritize preventing systemic failure. And the assets that matter most to system stability are the ones held by the wealthy. So the protection emerges naturally as a byproduct of how we built the machine. The real question isn't whether the system favors wealth. The evidence is everywhere once you look. The deeper question is what happens next. Because when more people realize they're working inside a structure that feels mathematically stacked, trust starts to thin. And modern finance runs on trust, the way engines run on fuel. If the design keeps protecting the top while pressure builds below, does the system adapt? Or does it wait until the stress forces a rewrite no one can control?